We're live. Take it away,
Hello.
Claude.
G'day. Hello, everyone. Sorry, we are a few minutes late, but it is that super busy time of year. Uh, Let me just mute that. Thank you for joining us. For anyone who's listening right now already, if not, if you're catching up with this later on, watching the replay, feel free to drop in a comment if you have a question that comes up after the fact. But yeah, basically thought we've had the company reports are coming in. We're right in the middle of deluge earnings season, so I'm trying my best to make sure that everything's edited, published as quickly as we can do. But at the same time, you don't want to sacrifice quality or time to think about things to try and just anyone can do that. Very fast stuff, which is more or less repeating the press release or whatever. So obviously, we don't want to just do that because that would be like competing with AI and bots and stuff like that. So we have to think about things. So now that we've had some time to think about things and digest, I thought we could discuss in particular. We've had two of the core original, the recommendations, which were both of them for a long time official buy recommendations. But now they're both hold recommendations. So that's why I chose them to discuss on this, public forum, because I think there's still heaps to learn about investing and about what the kind of style of investing I pursue is by looking at these stocks. I think they're great quality businesses for you to put on your radar. However, at the same time, these are, something we prepared earlier, and so we imagine, plenty of our supporters would own stock shares in these and maybe quite big positions now. If, like me, you bought them when I recommended them, or even before, they're big positions in your portfolio. So really, this is for you guys. So if you're there in the chat and you're a supporter, please put in any question you like, and I would love to answer it. But in the absence of any questions, I'm just going to go through some of the highlights here. So Hub24, the key takeaways here. I'm not going to read out the headline numbers. You can see them on the screen, or so you can read the article. But basically, we can look at some of the headline graphs and this earnings per share graph. What a basic way to start in understanding it. But you can see why the stock goes up, right? Like the earnings per share goes up, stock goes up. The PE ratio is the other factor there, of course, which is where you have to spend a lot of your time thinking about whether that's going to increase or decrease. But good starting point is they came out with good, strong earnings per share growth. The other thing we look at is, in a software business, net profit margin. So, and I think this is important. When I invest, when I'm trying to choose the official recommendations in particular, because actually I have different styles of investing that I practice, but the main game, the one that guides the official recommendations, is that we're trying to overweight management quality. We're trying to overweight business quality, because these ethereal things that are actually more difficult to put in a spreadsheet, they are where we have a good chance of competing with the legions of analysts and their spreadsheets and the Excel spreadsheets and all of that kind of stuff. Why would I try and compete in numbers when my mates have basically machines that can do it? I'd prefer, try and focus on honing my ability to judge the things that are really difficult to judge, where no one can actually tell you how to judge the quality of a company. But if you do want a quantitative metric that is a very good indicator, just net profit after tax margin, look for a high one and look for one that's going up. You would be surprised how often that qualifies with a good quality business. So yeah, great to see that. And this is getting towards the big key takeaway of these entire results. Bang, okay, record results. You're not going to get a record results every year. You're not going to get a record results, every year from any company, even the best. But it was record results for Hub24 as measured by the amount of platform net inflow. So obviously, I'm talking to supporters here. So if you don't know what this company does, I apologize. It essentially is a platform administration for funds management. So you should definitely learn about this business, because it's a high quality business model, because it benefits just as markets go up, right? So it has fees that are kind of like of a percentage of the FUM that it has on its platform. And it's software that financial advisors use to manage their business, essentially. and look after their clients. But that's the core feature of it. So you want to see how much is the net inflows, just the normal ones that it's getting most quarters, excluding the large transitions. Now, it's a credit to the company itself that it's always provided this data excluding large transitions. Not many companies go out of their way to say, hey, this was a great quarter, but actually just you should put aside this bit because it was a bit of a one-off thing, and we might get it once every couple of years, but we're not going to get it regularly. So just exclude it as you track us. So this is what I track. They give us the conservative way to track them, and I do it. And this is the chart there, and it was still a record thing based on the conservative thing. And it was also a record thing if you include the large transitions, a record quarter. So yeah, what more could you want there? And then look, moving on, this is more a point of me wanting to bring this up as part of a discussion I think that Patrick and I can have. It's the comparison of Hub24 versus its main competitors in the markets. Now, it just so happens that both Patrick and I have taken we agree on one thing, which is that this is an attractive industry. So why is it an attractive industry? Well, basically, the mechanism I just explained, how it all else being equal, as long as share markets rise, then their fees will go up. That's a positive thing. Another thing is that they potentially, being software businesses, do have the ability to scale quite well. So as their revenue increases, the actual costs for serving that revenue, the physical costs aren't going to increase because they need to continually improve their platform each year anyway. So if they have an extra client, it's, no worries. Like if they get more revenue, they're still going to have to do the same activity. So that way they can definitely get increasing profit margins, which is the slide we saw before. That's why we like the industry. But now look at Hub24's position within the industry. The reason that I made this a recommendation was that a couple of years ago now, it started coming to my attention that Hub24, there were lots of heuristic signs. These are the ethereal things. They're not in a spreadsheet. Heuristic signs, which I won't get into now, that Hub24 had a more compelling offering than Netwealth. And at that stage, Netwealth was bigger than Hub24. And now Hub24 is catching up on Netwealth, and it's about to overtake Netwealth, which is a momentous occasion for Hub24. Final point. More looking to sociology here. There's not a particularly high short interest in this. So that's something I'd look for, because obviously high quality business like Hub24, if there are opportunities when I should be upgrading this to hold, I really do want to be aware of that, because even though I myself have already built my position, it's possible we could have supporters that have come on since I moved it to hold, which wasn't that long ago. Actually, it was like at $90 something, I think. But if there's someone who's come on since, they might be like, oh, should I buy it? Should I not buy it? So I'm always trying to think, should I be upgrading this to buy for people that didn't have any of it yet? And one of the factors I'll be taking into account will be this short interest stuff, which actually reminds me, before I go on a second further, we definitely need to definitely got to put this in notes, but this is not advice, by the way. The reason I chose to talk about hold recommendations, I'm definitely not suggesting any kind of trade, and also any statements I make that are defined as advice under the law, because the law decides what's advice, not me. As much as I intend this video not to be in any way advice, if it is advice under the law, then it is general advice only, which is authorized by myself, which is AR number 1297632. You can find these details in the notes of this video and obviously on the website and stuff as well. But obviously should have done that earlier, but also it's good to integrate it to make sure people can't just skip over it every time. So anyway, putting that aside, I'm telling you about my journey, about how I try and operate as the editor-in-chief of A Rich Life and serve our members. So that's how I'm going to be thinking about it. That's one of the things I'm going to be looking at. I'd like to see some high short interest, some lower sentiment. But yeah, the key takeaway here is essentially that this is climbing up the ranks in terms of, if I were going to rank all of the companies on the ASX by quality, this result takes Hub24 even higher up there. So Yeah, there we go. That's Hub24.
Sounds good. I'm curious. You mentioned that there were some heuristic signs that you thought Hub24 was a better product than Netwealth. What was it that you spotted that made you think that?
Oh, I can't remember all of them, and there was actually just a few like loose ones. But one of them, the most obvious one, was literally just the rate of growth, the numbers of people that Hub was adding each new half was increasing, whereas with Netwealth it wasn't. So yeah, it's like the increasing growth rate versus like I guess the fatter growth rate of Netwealth, but the flatter growth rate of Netwealth.
Fair enough. Fair enough. Shall I get into the Netwealth result then?
Yeah, absolutely.
Sounds good. Let me just get my screen share going here. Alrighty. Yeah, so I thought it was a very good result from Netwealth this year. Probably one of the things that stood out to me on the negative side was that the growth rate was a bit slower in H2 versus H1. I do say that somewhere here. I can't see where it is. If you look at it historically, the rates of growth have been a bit slower for Netwealth in the second half versus the first half. I can't really think of an obvious reason for that, but it does seem to have been a bit of a pattern. But all things, looking at everything here, it was overall a very impressive result. Funds under administration continue to grow. Platform revenue, which it continued to grow as well. But one of the things I thought was very interesting was that the platform margin has actually flattened out now. Now, I'm not sure if it's the same for Hub. We'll discuss that with Claude in a moment. But one of the issues that Netwealth faces, and to be honest, also so does Premium, is that as the account balances, the average account balance gets higher and higher, because people add more money to their account or because the market goes up, etc., more and more accounts are hitting the fee caps, which is limiting the platform margin that some of these companies are earning. So I think that's a problem that a lot of these companies are going to face in the years ahead and are already beginning to face now. I suspect those caps might move up a bit over the next few years. But I thought the way Netwealth is approaching it was quite interesting and innovative in that they're trying to, I guess, look for alternative sources of fees other than just the administration fee. So one of the ways that they're doing that is to try and increase their capabilities around international trading and foreign exchange, because they can earn fees off that too. And that's really paid off in FY25 with international trading volume rising by over 122%, or by approximately 122%, I should say. Obviously, it's off a low base. It's not a significant thing right now, but it's encouraging to see them finding, other ways they can maintain those margins. One of the other things that really stood out to me was the cash flow. So looking on a strict free cash flow basis, it rose 31% versus last year to 109 million, which is a cash conversion ratio of 112%. So that means that their free cash flow was actually higher than their net profit, which is awesome to see. I would actually adjust that because I don't view the acquisitions that they made in FY25 as being, ongoing expenses. If you're happy to do so as well, then that would mean that you're looking at a 40% growth in free cash flow with cash conversion sitting at 120%. But yeah, the numbers all round were good. The effective operating leverage is still there. It is kind of a law of large numbers thing that it kind of reduces a little bit as the company gets larger, but net profit still growing faster than revenue, which is your best indication of that. It does look pretty expensive based on FY25, 75 times earnings. It's a great result, but you kind of need to have a great result when it's priced at 75 times earnings. So, one sec, Claude, let me just get you back on. Yep, all right, fire away.
In terms of pricing, I was just going to ask, what do you think about the relative pricing of Hub24 and Netwealth?
Yeah, so I think if we're comparing them on the same basis, because you looked at a few different ways to assess the price to earnings ratio for Hub, but if I recall correctly, I think Hub was on about 90 times if you just look at it as a simple FY25.
Yeah. If I was looking at FY25, is that what you were looking at when you said 70 something as well?
Yeah, that's right.
Yeah, so it's like whatever 90 something times estimated earnings versus 70 something times estimated earnings.
Well, mine is based on actual FY25 earnings, not estimated. I assume yours is as well?
Oh yeah. No, yeah. Sorry, the 90 something is on FY 2026, I think. And
okay.
Oh no, sorry. The 93 P ratio is using underlying earnings per share, which is reasonable enough. That's kind of generous though. If you use statutory earnings per share, it's 115.
Yeah, that's kind of the key difference between the two. I think they're both great businesses, right? I think they're clearly the two leaders, and I do think that there's room in the market to have, two premium companies on this. Right now, I would agree with you that Hub is looking like a higher quality business than Netwealth, primarily around the flows. Right now, or I shouldn't say right now, based on 30 June 2025, Netwealth is still just ahead based on funds under administration on the platform. But we're literally talking like it was 112.8 versus 112.7 billion. So by August 21st, it wouldn't surprise me if that's actually already changed. But there is a valuation differential there. I would actually like to own both, to be honest. But I haven't. I was buying Netwealth last time we had a market dislocation. Next time I might have a look at Hub, but I think they're both great businesses. I'd be happy to own, either one or both. But right now, looking at the valuation, I'm probably a little bit more valuation sensitive. I think you're probably a little bit more quality sensitive. That's probably why we ended up in the two we did.
Yeah, I just think it's an interesting versus battle. I reckon that I've got the better of it, and I'm pretty sure that like in the what's the comparative share prices?
What period are we looking at?
I don't know. Anything you like.
All right, let me bring something up. 1 second. All right, so over the last 12 months, Netwealth is up 53%, close enough, 52.98. Over the last 12 months, Hub's up 100%. Yeah. Year to date, 53.9 for Hub and 23.34 for Netwealth. So,
and it's also, if you look at it along a longer time frame, it's like 5 years or whatever, which I think is generally a better thing to judge things. I think Hub24 is also like hitting it out of the park.
Yeah, so Netwealth, I'm going to have to do this in my head because it's not giving me the number, but 13, up roughly 2.5 times, something like that.
5 years, like Hub24 is up around 600%, whereas Netwealth around 160%. So
yeah. And look, I think one of the key things there, and I think this is an important thing to note, is that this isn't necessarily just about these two companies, but just a general note on investing, I guess, is that if you look back 5 years ago, I think Netwealth was the clear leader in the space, right? But Hub has improved its quality over time. And for me, a business that's improving its quality is where I'd like to be. So high quality is good, yes, but I want to see a path to them improving their quality. That's when you get re-rates.
I feel like reading our reports, mine's more like making the case Hub24 is improving quality with these reports. I don't know if yours makes the same case for Netwealth though. So anyway, I reckon that I reckon there'll be more outperformance for Hub over the next 5 years. Maybe not as much as the last 5 years though, because at some point I reckon, it'll, as you sort of you allude to, once you get bigger, it does become more difficult to maintain the same growth rates. But I guess we shall see. Anyway, look, I want to wrap up soon, so I want to move on to the last stock. Can you make it back to my screen sharing?
Sure can.
Yeah, so as with Hub, in which I own shares, Netwealth, which Patrick owns shares in, I own shares in this one as well, which is Energy One. I reckon this is a little small cap company that you're gonna like. If it stays on the same trajectory, I reckon we'll be hearing more and more about it. I am like strongly considering, like, these results definitely were top notch. As you can see, record revenue in the chart that I've got there. But then if we go on, you can just see this big rebound in the profit margin. So these guys do energy trading, wholesale energy trading software. So like we were talking about with Hub24, as they get bigger, as they scale, you want to see that profit margin going up. And as you can see from the chart that's in front of you now, the profit margins dipped massively for a number of reasons. Some of it bad luck, also just digesting of sort of big acquisition that they did. And so as a result of a number of things that happened, like a cyber hack and the takeover offer was a bit of a distraction, etc., etc. Basically, the profit did temporarily fall even to a half year loss. So it's been a big recovery for Energy One since then, obviously. And in the long term, the thesis for the stock is that net profit margin should actually continue to even get eventually to higher highs than it's ever been before, because that's what you want to see in a software company as it scales. They also reinstated the dividend. As you can see here, half year earnings per share went to a massive new high, and then also so they've actually reinstated that dividend. And one thing I'd like to call out is, even though I'd be perfectly happy for them to actually just pay off their debt more and also strengthen their balance sheet, even get a cash kitty, I'd be happy for them to do that. But I do also respect how the chairman said on the conference call that the dividend policy says 40% of net profit as a dividend, and that's a payment to shareholders for our success. And he basically, I don't know, I feel like the dividend kind of speaks to the attitude of the company towards its shareholders. Like, that does want to include shareholders in the profits of the company, but it's willing to cut the dividend when, the profit's under stress or it needs to pay off some debt or something like that. So I think that's pretty reasonable. And it's a big position for me. And you can see there, I guess, final chart is that the free cash flow was, at its record levels. Keeping in mind that the record free cash flow result in this half year is not going to be repeated next half, because the first half, as you can see there, is always lower due to that's been when the bonuses are going to get paid. So I guess that's the Energy One. Very strong results. I definitely am wondering, at what price should this be by? Could go up down from here. I've got no idea, no crystal ball. It's just one of those situations where it seems like it's emerging high quality company, does trade on a high PE ratio. I think we're looking about trailing PE ratio of 80, which is pretty high. And yeah, look, I guess as the history shows, it's not always smooth sailing, and there could be rough seas ahead again. So in that case, I'd expect a retrace given the lofty PE ratios that we've got right now. Having said that, nonetheless, I definitely upgrade my view of the stock after these results. So I'd consider them really, really good results. It's just that the share price has obviously run a long way. I think, and also a negative that actually is one thing that even did cause me to sell or to like issue a recommendation to sell 5% of our initial holding, which was the long-serving CEO who's been absolutely such a legend. He is going to go after a long handover period. I think still more than a year away. He's going to stop being the CEO. He's going to retire and go on the board. This should be fine. I honestly think this will be fine. Of course, my style of investing definitely overweights things like a long-serving CEO leaving is just, generally speaking, in my point of view, one of the most underrated like negative signals that's out there. It's like, this is the thing that doesn't fit into the market spreadsheet. So everyone's giving it extra weights. Like their own different weight, basically. But it's really hard for a broker analyst, if the CEO is leaving, it's like hard for a broker analyst to be like, oh yeah, and now I downgrade my valuation, because they've got all of these spreadsheets that link their valuation to, the profit in 5 years and DCFs and all of these inputs. And like CEO, is the same CEO in place, is not like a cell in the Excel spreadsheet. They can't like update it and it changes the valuation. So and then if they do want to, basically it's these ethereal things that it's hard to like they're the things that are hard to be factored in. So even though I actually think that there's not really about I think that the company's handling the impending retirement of the CEO in like literally the best possible way, it's still a negative by my framework. But yeah, overall sort of regret that, and just think that this was a great set of results, and happy to hold. So that's all I have to say about that, really.
Can't argue with that. I regret not getting into. Oh, that's interesting. My video just turned off. Sorry about that, people. I don't.
That's okay. Don't worry about that, man. Look, I'll just actually thank you very much, Luke. Absolute legend. You have given us a question. So please, other viewers, I know you're there. You got to ask something, but I think we'll just do this question from Luke, and then might wrap it up. So he basically just said, talking about the valuation versus quality debate further, how do you think about premium, which is ticker PPS, when adding to that debate? Clearly lower quality, but cheaper. So I definitely agree with that point. Also, Patrick has written an article about premium on the free website. So I think I don't know if it's free actually, but anyway, it's on the website.
I think it is, yeah.
And yeah, it's free now. So that's definitely worth a read. And he owns shares as well in premium. But yeah, basically with that, I guess the argument for premium is it's literally in the same business, which we all agree is a good business. And essentially, it's just a lower quality version. I think that it's got the right strategy. It's got, it's got a plan that could work. But basically, in my opinion, I just think that it probably doesn't have the best product. It probably doesn't have the best distribution network. It's actually a messy situation, as outlined in Patrick's article, about how it has acquired all these different businesses, and then they're like migrating them from one platform onto another platform. Like they're really in the weeds. It's like the drudgery work. Having said that, it's a much cheaper multiple of earnings. So there's this argument where you could be like, well, it's in the drudgery now. It's in the weeds now. But once it cleans up its business and puts it on a bit of a better trajectory, it'll very quickly like get a bit of better growth, and also then a higher multiple. And the CEO himself like clearly understands that it's like all about how quickly can you increase the amount of inflows into the platform. So it's the rate of inflows that really makes the biggest difference to valuation, because like as I said, like that's like that's not the guaranteed growth, but that's the growth tendency, because markets will go up and down. And that's the more that inflow is, the higher chance that this company is going to be growing in the next year and the next year and the next year. So yeah, that's an interesting one. For me, it's like my philosophy of overweighting things like quality of the business means that I definitely want to be in I'm happy to be in Hub24 rather than something like premium. But that doesn't mean there's not still an opportunity in premium. It's just not one I'm taking, which brings me to one of my favorite sayings, which I'm trying to proliferate around the world for describing this quandary in investing, which is that you can't pat all the fluffy dogs. So you don't have to get all the good ones that go up. As long as you get some, then you'll be fine. So I guess on that note, Thank you for listening, everyone. We'll just go through the traditional disclaimer at the end as well. So the information contained in the report is not intended as advice. And actually, Patrick, do you have the video?
Yeah, I was just about to say I can play this on video. So thanks for listening, everybody.
He's going to play the disclaimer.
Yep.
Thank you for joining us. Thank you, Luke, for the question. You're a legend, mate. And have a good one, everybody.
Roll disclaimer.
Guests or podcast hosts may have positions in the companies mentioned in this recording. The information contained in this financial advice and is not a recommendation to buy or sell any financial products. We do not warrant or represent that the information, opinions, or conclusions contained in this episode are accurate, reliable, complete, or current. And you should be aware that any references to past performance are not an indication of future performance.